And that's why we say tell that to the bond market, because it doesn't really matter what the Fed chair says. It doesn't matter what the labor market conditions are or whether inflation is sticky or not sticky. None of that really matters. What matters is which way does the bond market want to set rates. And at the moment, it looks like we have begun the downside portion here that we've been calling for a little while. We were calling for it in here, and of course we were calling for rate cuts at the prior FOMC. However, what we got, of course, was the 10-year yield move higher as the bonds experienced a capitulative move, and thus we knew that we weren't going to be seeing rate cuts into the prior meeting. Since then, of course, as you can see, we have indeed started to resume the downside move here. I expect this is going to accelerate as soon as we get below 4%. Of course, nothing moves in straight lines, okay? I, for some reason, need to make this clear every time. I'm probably expecting something akin to this, okay? So there will be large counter trend bounces along the way, and people will get very kind of engagement farmy around those types of counter trend rallies. But overall, I believe the trend is down now for the rest of the year. I believe this was indeed a trap as bonds capitulated, and thus I believe we're going to see a bunch of rate cuts as we head into the remainder of 2026. What's super interesting to me about this, okay, is if we are cutting rates into normalization, which is to say a return to baseline inflation without a recession, okay, whilst having a soft landing, then these rate cuts are typically extremely bullish for risk assets in the stock market. However, if we are indeed cutting into a slowdown, normally within the first 3 rate cuts, we would start to see bad things happen to the stock market. Now, these are just averages, so it's not a magic formula in which we get 3 months after the first cut and markets start tanking and we have to exit the market or anything like that. And this cycle's been a bit strange because we actually got a token rate cut, didn't we? We were paused for a while, then in September we saw that kind of token rate cut where we then went to a pause again and stayed paused for a while before ultimately experiencing a few cuts since, okay? But if we ignore that kind of weird token rate cut that happened back in September and count the next leg down as like the beginning of the cutting cycle, then we're getting right into that neighborhood now where averages say, if indeed this is going to be a recession type cut,